Welcome back to Investing Talk Podcast.
Today we're looking at energy fuels, the integrated player in uranium and critical minerals.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. If you only knew this company as, a simple uranium developer a few years ago, you really need to update your whole perspective.
Yeah, that picture is completely out of date.
It is. The core story here is this massive, active transition. They're moving into being a much more complex integrated producer.
So not just uranium anymore?
Not at all. Uranium, yes, but also rare earths and even other critical minerals like vanadium. That's a whole new ballgame.
Okay, so let's unpack that transition. We've been looking at the latest results from Q3 2025, and it seems like management is getting really clear on the timeline.
They are. They're pointing to 2026, maybe 2027, as the real inflection point.
And this isn't just some, hopeful guess. This is when they expect to see meaningful revenue.
Meaningful revenue scale, exactly. Hitting the books from both the uranium side, which is ramping back up, and crucially, from this new rare earths segment.
That timeline, it feels like the entire investment thesis hinges on them hitting it.
It absolutely does.
Yeah.
And what's underpinning this whole ambitious plan is a really solid financial foundation. This provides a ton of resilience.
Right. This isn't some junior miner burning through cash on a prayer.
No, not at all. We're looking at a balance sheet that is very debt-light and liquidity-rich.
Which in a capital-intensive industry like mining is everything.
It's critical. It gives them so much operational flexibility. When commodity prices inevitably swing or when costs go up, they can fund their growth internally.
And the way they're allocating that capital really confirms that long-term focus, doesn't it?
It does. You're not seeing a big dividend program or, a massive share buyback right now.
No, every dollar seems to be going right back into the ground, so to speak.
Yeah, exactly. Aggressively reinvested for growth, specifically into these really necessary upgrades for the White Mesa mill and building out those rare earth separation circuits.
So that cash is turning into hard strategic assets.
That's the definition of building long-term value, even if it makes the near-term cash flow look a little constrained. It's a strategic choice.
Okay, so let's talk about their historical core then. Uranium. Their timing here seems, perfect.
It really is. Their whole strategy is to ramp up their uranium output right into what is a structurally very tight market.
And the pricing data just screams margin expansion. We pulled the numbers from the end of October 2025.
What are we seeing there?
Spot price for U308 was holding strong at what, $82.50 a pound?
Right around there, yeah. And even more telling is the long-term price.
Higher. It was at $86 per pound.
And when you see long-term prices above spot like that,
Yeah.
It tells you everything. The utilities are actively trying to lock in supply because they're worried about future shortages.
So if this company is ramping up its volume into that kind of pricing tailwind,
The potential for margin expansion is just enormous on every single pound they produce.
But let's get to the real differentiator, the thing that makes this company more than just a commodity producer.
The competitive moat.
Yeah.
And it all centers around one asset, the White Mesa Mill in Utah. You really have to understand the importance of this facility.
It's kind of a twofold importance, right? First is just the fact that it's operational.
Exactly. White Mesa is currently the only conventional uranium mill operating in the entire United States.
The only one. That fact alone puts them right at the center of any conversation about U.S. energy security.
It does. The government basically needs that facility to exist. But the really fascinating part, the genius move, is how they've leveraged that existing infrastructure to jump into rare earths.
Right, they've retrofitted the mill.
Crucially, yes. It's now one of the only facilities in the entire Western world that can process monazite sands.
And monazite is that mineral-rich sand that contains the rare earth elements that, China currently dominates.
That's the one. White Mesa can take that feedstock, process it into a rare earth carbonate, and now they're taking the next step towards separated oxides.
Which is the high-purity stuff that manufacturers actually need.
That's the end product.
So this idea of a strategic processing monopoly, or at least an oligopoly in North America, that's the key insight for listeners. Why is it so hard for someone to just build a new one?
The barriers to entry are, they're practically insurmountable today.
Yeah.
It's not just about the capital, which is massive.
It's the permitting.
It's decades of permitting, environmental hurdles, political opposition. You just couldn't cite a new mill like that in the U.S. today. That existing infrastructure is priceless.
So it's not just a mining company, it's an infrastructure provider.
That's a great way to put it. And it makes them a linchpin in the whole U.S. critical supply chain discussion. They're often mentioned alongside major global players in the rare earths race, but they have this unique edge.
Because they're already embedded in nuclear and defense policy.
Right. It gives them a voice in Washington that a lot of their competitors just don't have.
Okay, so that's a very compelling bull case. It's anchored by this irreplaceable asset and clear geopolitical tailwinds.
Oh.
But we have to look at the other side.
We have to. We need to pivot and look at the risks, the bear case, because the high expectations we just laid out are definitely priced into the stock.
Let's hit those risks hard because the valuation is the big sticking point here. The first one is earnings risk.
Yeah, the street consensus is still looking at net losses for the near future.
For 2025, the forecast is for negative earnings per share of around 35 cents.
And it's still projected to be negative in 2026, a loss of about 6 cents. So the market is pricing this based on 2027 and beyond, completely ignoring today.
And that flows directly into the valuation risk, which is huge.
It's huge. If you look at its forward price-to-sales multiple, the PS ratio, it's trading around 39.7 times.
Okay, let's put that in context for people. The industry average for miners in this space is what?
Closer to 3.7 times.
So, nearly 10 times the industry average. That is an enormous premium.
It is. The market isn't pricing current revenue. It's pricing future policy, successful execution, and that national security value.
But doesn't that make it incredibly vulnerable?
Absolutely. That premium makes the stock acutely sensitive to any bad news or, a general market downturn. And that brings us to the main source of potential bad news, execution risk.
Right. It's not easy to just flip a switch and scale up uranium production across mines that have been dormant.
It's a massive challenge, and they have to do that while also securing a consistent supply of monazite feedstock and, most critically, commissioning these incredibly complex separation circuits for the rare earths.
Any delay there, say a 6-month setback on the separation circuits,
it would push that cash flow inflection point out past 2027, and that would really frustrate investors. It's a wall of worry they have to climb every single day.
And yet, despite that wall, the technicals suggest investors are being patient. They're buying the dips.
They believe the story. The charts show that. The stock's been trading in, what, a $15 to $16 range?
Yeah, around there. But you have to remember the volatility. The 52-week range is wild, from about $3 all the way up to over $27. This is not a sleep-at-night stock.
No. But while the near-term sentiment is sort of bullish, pointing to maybe 1657, the real story is the long-term support.
You're looking at the 200-day moving average.
The 200-day EMA, yeah. It's what big institutions watch. And it's way down between roughly $7 and $9.50.
The fact that the price is so far above that deep technical floor, that confirms a very strong long-term uptrend.
It provides a wide technical buffer. It signals that big money sees any drop as just a dip in a bull market, not a reversal.
And the momentum indicators kind of back that up.
They do. The RSI, the Relative Strength Index, is neutral, sitting right around 49.
Not overbought, not oversold.
Exactly. It's classic consolidation behavior. The stock is just waiting for the fundamental story to catch up before its next big move.
Which ties right into the current market sentiment. The headlines are broadly neutral. It feels like a wait-and-see moment.
Investors are reassessing, not running for the exits. The long-term narrative about American independence is holding the line.
Yeah, that narrative is incredibly powerful. When you see headlines asking things like, can this company lead America's drive for rare earth independence? You realize this theme isn't going anywhere.
Geopolitical policy is the floor under this high valuation.
So if the market's just waiting, what are the catalysts? What could break this holding pattern in the next, say, 3 to 6 months?
Well, the next big scheduled event is the Q4 and full year 2025 update. That's where we'll get fresh guidance from management.
Not just on production, but on contract wins.
Yes. Any new contracts for either uranium or the rare earth products would be a huge shot in the arm.
And beyond the scheduled stuff, any surprise announcement of a big off-take agreement?
That would be a major immediate catalyst. It directly addresses that revenue uncertainty and the earnings risk we talked about.
And then there's the wild card, which is always macro policy.
Always. Any move from the U.S. government on energy security or critical minerals, new subsidies, strategic stockpiles, anything like that could re-rate these U.S. producers overnight.
There are also those more speculative angles floating around, right?
Yeah, nothing confirmed, but things like government loans or grants tied to national defense, or even a strategic partnership with a major defense contractor. It's all credible given the uniqueness of White Mesa.
So we come full circle back to the core thesis. Why would anyone tolerate that staggering PS multiple?
It's because the market sees this stock less like a regular miner and more like a strategic, highly leveraged option on U.S. independence.
The idea being that the high valuation is okay because the earnings will eventually grow into it rather than the price falling back to the average.
Exactly. You're betting on execution and you're betting on policy. And the structural drivers backing that bet are powerful.
Decarbonization, needing more nuclear, geopolitical diversification, a 9.4% growth rate for the U.S. rare earth market.
Those are powerful long-term trends that help mitigate the cyclical risk.
So if you're looking at this as a strategic investment, what's the time horizon?
I think this is primarily a 2 to 4 year, multi-year hold. You're betting on that whole thesis playing out.
Though, given the volatility, there are definitely shorter-term swing opportunities around news for anyone with the stomach for it.
For sure. In the next 6 to 18 months, any contract news could cause a big move.
You know, what's so fascinating here is seeing how the convergence of nuclear policy and critical minerals policy is creating these incredibly scarce assets. It really is a story where operating leverage meets geopolitics head on.
Absolutely. If you want to keep up with these multifaceted investing stories that blend macro policy with fundamental analysis, make sure you hit that subscribe button before you go.